What's going on, everybody? This is Matt Rinkey, the founder of Illumination Wealth. Really excited to chat with you today and have my esteemed colleague, Eric Niergarth, certified financial planner of Illumination Wealth, joining me to talk about a very meaningful topic that always shows up around this time of year, and that is philanthropy and charitable giving. So Eric, turn it over to you for a second. Maybe you want to introduce yourself and share a little bit who you are.
Yeah, thanks, Matt. So I joined Matt's firm in April during the middle of the pandemic. And before that, I was with TD Ameritrade for 10 years. And yeah, it's been a blast working with Matt and all of his clients.
Awesome. Yeah, no, it's a pleasure to be partnering with you. And so, as we embark on Thanksgiving and the holiday season, I think charitable giving becomes front and center for many people. Some because it's just the time that they give, and others, it's, there's tax related reasons why people give towards the end of the year as well. And there's that tax deadline. But I think for us, we work with a lot of business owner and entrepreneurial clients. And what I find fascinating is that they're very much giving by nature. And I found that like over 90% of business owners are actually contributing to charity either personally or through their business. And they want to not only make an impact by their business, but they want to be able to use their wealth to make an impact and make a difference as well. So I found that to be pretty fascinating, and hopefully more people get in the giving spirit as well. And so as we kind of digress and talk a little bit about the charitable giving environment, I wanted to ask you, something changed this year with the CARES Act earlier on that changed how charitable giving would be approached from a tax perspective in some way, shape, or form. Can you share a little bit about like what's going on with that?
Yeah, it's a small change that hopefully will have a big impact. So the change essentially allowed people that don't itemize on their tax return, which at this point is almost everybody. It allows you to have a $300 cash donation be tax deductible above the line. So previously you had to itemize to receive any form of tax deduction. Now anybody that's gifting to an eligible charity has that ability to get a write-off up to $300.
Awesome. Yeah, no, certainly a change. And I think what you were saying is many people are not itemizing their deductions right now because the standard deduction is over $24,000 for a married couple. So you need to have property taxes and mortgage interest and other deductions in excess of $24,000 to even make your charitable contributions receive any tax benefit from doing it. And so the change essentially is allowing anybody, basically, if you donate up to $300, you're going to get a tax deduction for it, depending upon your tax bracket.
Exactly that. And even if you did it earlier this year, make sure, maybe you forgot about it. Make sure you go through your transactions to see if you've done anything. And this change, they brought it about during the COVID pandemic, but the law looks like it's going to stay going forward. So that should be here for years to come.
Awesome. Awesome. And I know for many people, the reason why they give isn't because of tax, but I think it's also interesting that it does have, tax advantages, and which enhances wealth for your family and also for the community because of this. And so, for those people that, might not be able to itemize deductions in the past, but perhaps have a really big income year, or they have, a windfall of some sort. Is there what do you think that they could do to get a bigger deduction that they otherwise wouldn't do if they didn't itemize?
Yeah, so the main way people are doing this now is what's called a donor advised fund. So essentially it's a fund your family sets up with an appropriate custodian that holds these funds, and you can contribute a large amount into these funds that you're going to be gifting to charities for several years to come, maybe even over the course of your lifetime. And the benefit of this is you're getting an immediate tax break in the year that you make the contribution, but then you can continue to use this fund year after year after year. And you can also invest the contribution that you make into this fund, allowing it to grow for future years and allowing you to gift more over time.
Yeah, awesome. Yeah, donor advised funds can be pretty powerful. And so I guess one of the things that I was hearing you say is that it allows a donor, somebody who wants to make a charitable contribution, you could potentially lump multiple years of your contributions into the current tax year, and then so you get a big donation in one year, and then the donor then has the control as to when they're going to make the actual charitable grants or when they're going to dole that money out. Is that right?
Yeah, exactly right. And then in addition to that, if you didn't want to go the donor advised fund route, you can still group your donations in one year. So whether you itemize or not, if you have a high income year and you're in a high tax bracket that maybe you won't be there in future years, you can just decide to say, I'm going to do the next 5 years of gifting this year. So I'm taking advantage of those high tax brackets and getting a larger deduction.
Awesome. Awesome. And so, yeah, with these donor advised funds that, you put the money in, you still have control. There's not restrictions for the donor to say when they want to make the grants. There's not, you have to give away X% each and every year like a private foundation. So you have some control to let that money grow and compound, which is very powerful. But as soon as you do donate that money, it's no longer your money. It's really the charity's money. You just you just have control over who we want to give it to and when we want to give it to, and how we want to invest that money for the future, essentially.
Exactly. Yeah. Yeah. It's sort of an easy way to have your own little private foundation.
Yeah, and what I found that some people like about this, especially higher net worth people, is that it can be very private. Whereas a private foundation, even though it's private, there's IRS reporting that's public for everybody to see. Whereas for some, having a donor advised fund comes with a lot less cost, a lot less complexity than setting up a private foundation, and there's even greater anonymity involved. So there's pros and cons to both. But I think this is a really good way for people to be able to give and contribute a lot and retain control and have the contributions or the organizations that they support. They can kind of prove themselves. So they're not giving them a chunk of change all up front. They can see, are they really putting my gifts to good use over time before they make future grants from that fund? So yeah, great point about those donor advised funds. I think they can be pretty powerful for the right people. That's awesome. That's awesome. And so then you talked about gifting and lumping and kind of bunching your charitable donations together. And so the point of that was what again? Just remind us.
Essentially taking advantage of if you have a high income year where your tax brackets are really high and you have philanthropic intent and you're going to be gifting, you're just taking advantage of sheltering your income tax at those highest brackets.
Yep, exactly. And I guess the other point is that this might allow you then to itemize deductions as well. So if you weren't itemizing in the past, if you lump your donations, it might get you over that threshold to allow those contributions to then be deductible from a tax perspective. So something really, those are all a lot of things to consider in terms of gifting and charitable giving, towards the end of this year. But a few things that we wanted to also bring up is that when we think about giving, it's not just cash that needs to be donated. Individuals, people have the ability to donate stock. They could donate shares in their business. They can donate real estate. You can donate artwork. You can practically donate anything that has a tangible, value to it. And so one of the things that we've been doing with some of our clients now, that the stock market has recovered and it's now back at pretty much all-time highs, is that you can donate stock instead of donating cash. And the benefit of that is that if, let's say, you bought Apple 10 years ago and it's now gone up tenfold, you can donate some of your Apple stock and you don't need to pay the capital gain on that, nor does the charity. So you're really gifting something that might have had a $10,000 value. You paid $10,000 that could be worth $100,000. You're able to donate $100,000 of that value today, for example, and get it all, get that all as a tax deduction with some limitations. Whereas if you donate cash, you're using your cash. So we're avoiding capital gains tax, and the charity doesn't need to incur the capital gains either when they go to sell it. So that's another powerful thing for people to be thinking about. What resources are they using to actually gift and give? And Eric, can you use donor advised funds to donate stock and contribute stock to them?
Yeah, absolutely. They can accept those.
Yeah, so I think donor advised funds can pretty much accept any type of, they could accept real estate. They could accept, stocks or mutual funds. They can accept cash. So as you think about things, figure out what's the best, most impactful thing to contribute when it comes from a tax perspective, and making the most of all the resources you have out there. So one other thing to note, when you are giving, donating appreciated stock, the amount that you can deduct is limited to 30% of your adjusted gross income. So for example, if somebody had $300,000 of adjusted gross income, the amount of stock that they could donate is limited to $90,000 to get a deduction, a tax deduction. So even if they were to contribute $200,000 of shares of Apple, they could only deduct the $90,000 this year, and then there'd be a carryover to future years. Cash, though, is a 60% deductible amount up to adjusted gross income. So if you make $300,000, you could donate essentially over $150,000 of cash and get a full tax deduction for that. Is that correct, Eric?
Yeah, that's correct.
Yeah, so those are a few big things to be aware of. And then there's more sophisticated planning that I think business owners, those that are preparing for the exit of their business, can consider when it comes to setting up charitable trusts to minimize taxes upon the sale of their business. And so there's things such as charitable lead annuity trusts and charitable remainder trusts that are out there that we can dive into on a future conversation that provide some pretty unique income tax advantages, as well as estate planning advantages, as well as the ability to utilize those assets in your lifetime. Even though some of it's going to go to charity, you still have the ability to utilize those assets, or for those assets to go on to your beneficiaries down the road. So there's some really powerful advanced charitable planning techniques that we'll continue to talk to you about. But hopefully this gets your mind going as you think about how you can give and how you can contribute towards the end of 2020 and beyond. So Eric, thanks for joining us and dropping knowledge. Definitely appreciate it.
Yeah, thanks for having me.
Yeah, absolutely. And we'll do it again and take things to the next level.
Awesome. Thank you, Matt.
Thank you.